There have been so many talks about the AI bubble busting lately. It's just like people can't wait for the stock markets to crash. And I have to say, that's not a good thing, really. A crash means people lose jobs, retirement accounts get wiped out. It's not something to look forward to. So today I'm trying my best to lay the cards on the table. I'm going to show you what I have observed, the actual mechanics of what is happening in the AI economy. And yes, by the end of this, I do think that a bubble will pop eventually, but not right here, not right now. And I will show you precisely what to watch so you will know when the real warning signs appear. Hey, I'm Jane. I study the gap between what's being sold about AI and what's actually happening. And right now, there is a massive gap between the panic in the headlines and what data actually shows. This is a collaboration article between myself and my partner, Klaas. He's a veteran CTO, but also someone who has a deep understanding about the macro economy. Let's break this down. First, we need to get one thing straight. Your auntie or neighbor who just discovered ChatGPT this Christmas, awesome, cool. AI is useful. But don't take that as the same as something that moves Nvidia's stock price. So see, here's where most people get confused. They think I use ChatGPT and everyone I know uses ChatGPT. Therefore, AI is doing great. Or they think I try ChatGPT, it always gives me wrong answer. Therefore, AI is overhyped. Neither of those things, sorry to disclose that to you, matter for whether this is a bubble. The value of a technology is never the same as the value of a company in the ecosystem. Let me say that again because it's crucial. NVIDIA's stock valuation isn't built on how many people use ChatGPT. It's built on expectations, especially how many AI chips will giant companies buy next year and the year after that. So, when people ask, is AI a bubble? That's the wrong question. The real question is, will companies keep spending billions on chips at the rates that Wall Street expects? And this is exactly what we need to figure out. So let's look at who's actually spending the money and who is an important player in this whole AI economy game. Okay, now I know many people might think, oh, there's so many names flying around and such a complex system, which is actually not true. I know I might be overly simplifying it, but this will really help explain the whole mechanism. So stick with me here. Think of it like a restaurant supply chain. You've got upstream, the farmers growing the ingredients, you have middle stream, the distributor and the warehouses, and you have downstream, the restaurants serving customers. In AI, it works in a similar way. So you have upstream, the chip makers, well, not that chip, the other chip. At the top, you've got NVIDIA. And of course, before NVIDIA, you have TSMC and you have all the other suppliers. But don't take that into account yet. Just keep it simple. You have NVIDIA. They're like the farmers. They design chips and that powers everything. So here's a little history about NVIDIA. There was always an AI company before 2016. They made graphics cards for video games, gamers like me. Investors valued them at that time like a consumer electronics company. But then, when they started to figure out that their GPU is actually effective for AI training and development, they pivoted to AI. And suddenly, investors say, hey, wait, this is infrastructure, this is enterprise spending, and this is more stable. So the valuation jumped. And here's what the headlines have been screaming about lately. NVIDIA's inventory has been building up. It went from like $10 billion to nearly $20 billion. So that's like double it. And it's taking longer to convert that inventory into cash. In a traditional business analysis, that is a huge red flag. Inventory up plus slower sales usually equals to falling demand. But hold that thought. There is another explanation. Now, let's have a look at the Midstream companies, the data center builders. This is where it gets interesting and slightly complex. Let's again use restaurant for example. You got companies like CoreWeave. Think of them like a commercial kitchen rental company. They buy all the expensive equipment, in this case, Nvidia chips, build data centers, and rent out computation power to companies that need it. Now, here is one thing you need to keep in mind about business models of CoreWeaves. If you are Chick-fil-A, you buy ingredients, you make chicken sandwiches, you sell them, and you've got cash in the register by the end of the day. CoreWeave, slightly different. They have to spend billions building data centers, and that takes years before they could start charging rents, and not to mention having a proper return. So how do they survive it? The answer is debt. Lots of it. They have $1 billion per year, hold on, just in interest payment. And another thing that's also slightly worrying in their business model is that 70% of their revenue comes from one single customer, Microsoft. And they are counting on $22 billion of the future revenue from OpenAI, who isn't profitable and also have an agreement with Microsoft in place. Did you see the problem a little now? Don't worry, we will dive into detail later. And then there is Oracle. They're trying to compete with the big boys. But here's the issue. They still have only 3% of the cloud market. Of course, they've been trying to fight the big guys like the AWS or Azure and Google Cloud, who have about 10 times of their market share. They are also doing it with a huge debt to equity ratio. That's 400% we're talking about. Just for some context, Amazon's is 50%. And there was also a news came out just last week saying that Oracle's credit default swaps, basically an insurance policy against them going bankrupt, just hits their highest level since 2008. Anyways, let's go to the bottom stream. The hyperscalers. At the bottom, you got the giants like Amazon, like Microsoft, like Google or Meta. They are Nvidia's biggest customers, but they're also Nvidia's worst customers because every single one of them has the money, has the engineers, and have the motivation to build their own chips and to cut Nvidia out entirely. In fact, Google is already doing it. Their TPU chips have been gaining real tractions. And there's also talks of Meta adopting Google's TPU chips by 2027. Here is another fact that you should notice of, that these companies are still spending massively, but yes, they also have a very stable business model, and they're not drowned in debt. So now we have some good understanding of who are the players in the game. Here comes two theories I'd like to share with you. Theory A, demand is falling. This is the headline stories that you've been reading in the last few weeks. Traditional analysis was said that when you see inventory piling up plus slower cash conversion equals to falling demand. Assuming this is true, Nvidia's in trouble because they can't adjust it quickly. They have a long turnaround time, and they're already committed to order more from TSMC, their manufacturer. Those chips are arriving and adding up to their current stockpile, whether customers want them or not. And while Nvidia is stuck in the current situation, the hyperscalers are also building alternatives. So some of those businesses might never come back. In theory A, we can summarize it as the inventory is going up, the conversion from inventory to cash is slowing down. They have more orders that coming their way from TSMC that they can't cancel and then they can't delay. And even worse is that chips, unlike some kind of hardware, it will last 10, 20 years. No, the current generation of chips will only last for 2 years, 3 years top. And then in the end, that their customers are building their own supply. So that's for theory A. The whole thing doesn't sound so bright and healthy for Nvidia. Now here comes theory B. Remember CoreWeave? They're one of the biggest buyer of Nvidia chips. In their last earning call, they basically said, we wanted to speed way more this quarter. We had a budget, we had customers waiting, but data centers were supposed to put those chips in. They just aren't built yet, and the infrastructure is running behind. So they have to push a huge chunk of their spending into next financial year. Not because demand disappeared like everyone suspected, but because there was physically nowhere to install equipment. To be fair, Satya Nadella at Microsoft also said the same thing, though you know me, I tend to doubt the motivation and the speech behind these big corporate CEOs. I know, like we should then also doubt earning calls, but I thought earning calls sometimes can really reflect the real picture than a CEO just randomly saying something to media. Anyways, just think about it like this. Imagine you're opening Chick-fil-A and you have ordered all the kitchen equipment like ovens, fridge, and everything. But your contractors are behind schedule and the equipment show up, but it's sitting there in a warehouse because the buildings just aren't finished. So that's not nobody wants ovens anymore. That's not even close to an indicators that your customers don't like the food in your restaurant. Hey, maybe they don't. Joke aside. That's we've got a construction bottleneck issue. And that's what's happening here. NVIDIA's chips are piling up not necessarily because customers changed their minds, but maybe because there is literally no floor place to put them yet. And now here's another thing I want to add. I'm sorry, I'm not trying to add the complication to it. Remember, I mentioned that Oracle's credits default swaps hitting a crisis level high? Some people look at it and say, see, I told you the AI bubble is busting. But is this an AI industry problem or is this an Oracle problem? Oracle has only 3% of market share. They leverage to 400% of the debt to equity ratio, trying to compete with companies that have vastly more resources. The hyperscalers, they're spending from their cash flow, not from their debt. So maybe Oracle's stress might be telling us less about AI bubble status, but more like an underdog who overextended get crushed. That said, there is a broader chance that Goldman Sachs is watching. These tech giants have taken on like 120 something billions of in debts this year. It's up from 28 billion average over the past 5 years. And here's a quote from them. A continuous shift towards debt financing would increase the micro risk associated with the AI build out. And when it reaches this point, maybe it's just no longer just Oracle. The whole ecosystem is using more leverage than before. Here's what I've learned after doing all this research. A few things that you should not use as indicators. First, headlines about AI bubble busting. Media sells fear. Fear brings clicks, so don't fall into that trap. Second, whether your neighbor uses ChatGPT, your neighbor is not a thermometer for the entire industry. And it's definitely not an indicator whether AI companies are financially healthy. Third, NVIDIA's inventory numbers in isolation. As we just discussed, there is more than one way to read that data. And if anything, here is that one indicator that you should watch. So plain and simple, hyperscalers CapEx commitments. That's it. That's the only signal that matters. As long as Amazon, Google, Microsoft, and Meta keep committing to data center build-out, GPU demand stays intact over a reasonable time horizon. The moment those CapEx numbers start dropping, and for this, I don't mean shifting to the next quarter because buildings aren't ready. I meant actually dropping because they are pulling back. That would be your warning sign. Right now, they are not pulling back. They are doing the opposite. So what do I do with this information? Honestly, just setting it out. NVIDIA has a lot of growth expectation baked in. The risk reward, it doesn't look great for going long, but it's also not a slam dunk short either. Maybe if we get some clarity on OpenAI's or Anthropic's future as viable businesses. Basically, anything that would meaningfully change today's narrative. Now, that's the analysis. Now you understand the actual mechanism and what signals actually matters. If you found this useful, please hit subscribe. If you want to go deeper, the full article is in the links below. As always, I share more detailed breakdowns with my community members. And if you are interested in discussing macro and AI, feel free to reach out to Klaas. Yeah, see you next time.